Great. Well, as everyone settles in, and I do ask that you chew politely and quietly, and we'll get our program started. But welcome, everybody. I appreciate you coming out this afternoon. My name is Scott Hodge. I'm president of the Tax Foundation, and I'd like to welcome all of you to our third edition of our Talking Tax Reform panel series that we co-sponsor with Intuit's Tax and Financial Center. As I mentioned, this is the third in our series. The first was on the border adjustment. The second was on taxes and family tax policy. And today is on the very interesting topic of the tax code as a barrier to entrepreneurship. Entrepreneurship and business formation are pretty critical issues these days, especially as we have an economy that seems to be stuck in neutral. Business formation seems to be flat. And of course, wages and employment seem to be stuck for many people in the economy. And according to the latest census data, there are more than 30 million private businesses in America, and the vast majority of these firms are small, and over 90% are what we call pass-through businesses, where the profits from the business are passed directly down to the owners. And most of them are small businesses. Well, you know, we see the Ubers and Lyfts and Snapchats all getting the headlines because they've grown very quickly and become very profitable. The business landscape is actually littered with many businesses that just never made it out of the proverbial garage. Census data tells us there were over 670,000 business startups or births in 2014, the latest data available, but more than 600,000 business deaths that year. So surviving the business climate is challenging at best. And there's certainly a lot of factors that determine whether or not a business succeeds, but the tax code is certainly a big part of that. So as lawmakers debate how to overhaul the tax code, they should keep in mind two essential questions. To what extent does the tax code inhibit entrepreneurship? And then, of course, the follow-up to that is what changes can we make to the tax code so that it no longer stands in the way of success? And we have a wonderful panel here today to answer these two questions. Scott Greenberg, to my right, is a colleague and an economist at the Tax Foundation. Tom Nichols, with the law firm of Meisner, Tierney, Fisher, and Nichols in Milwaukee, Wisconsin. He's also an advisor to the S-Corp Association. My friend Tim Kaine, a fellow at the Hoover Institution, former colleagues when we were at the Heritage Foundation all those many years ago. And of course, Donald Marin, who's Director of Economic Policy Initiatives at the Urban Institute and very well known here in Washington and on Capitol Hill. And we'll start with Scott, who will set the foundations for us with a broad overview of the type of business forms and some of the tax issues facing entrepreneurs based on our latest research. We'll move then to Tom, who has advised hundreds of businesses over his career, and I've asked him to give us a practitioner's perspective on some of the most common issues that he sees entrepreneurs and pass-through businesses in particular facing these days. And Tim, who's done a lot of insightful research on economic mobility, dynamism, and opportunity, will walk us through the role that government has played in slowing the growth of entrepreneurship in the economy today. And finally, Donald Marin will talk to us about how the tax code creates an uneven playing field for entrepreneurs and businesses, and how effective tax rates can vary widely across business types based on what kinds of business forms they are and how the business owner chooses to finance that business and many of the other issues that go into that. Now, if you have questions or comments, and if you'd like to live tweet, please use the hashtag #TalkingTaxReform. So with that, I'll open it up with Scott Greenberg, and thank you very much for joining us this afternoon.
Well, thanks so much, Scott. Entrepreneurs are an important part of the U.S. economy. At any given point in time, there are millions of Americans who are starting new businesses or working for the businesses that they've started. New businesses in the United States employ about 3 million people every year. To put that in perspective, about 1 in every 40 American workers is working for a business that was founded within the past year. All of this is to say that entrepreneurs are important. They're also a diverse group. There are entrepreneurs in all 50 states and in virtually every major industry, ranging from restaurants to technology, agriculture, and construction. And given the diversity of entrepreneurs, it's worth asking, can we make general statements about the tax code and entrepreneurship? Can we talk about broad ways about how the tax code affects entrepreneurs as a category? And what I'd like to suggest today is that I think we can. I think that there are a couple key characteristics that many entrepreneurs share that are relevant to understanding the barriers that the US tax code places for entrepreneurship. And I'd like to highlight 3 of those characteristics of entrepreneurs today. Number 1, many entrepreneurs tend to take a while to turn a profit. They often have large losses in their early years. Number 2, entrepreneurs tend to be quite risky ventures. Many of them fail, and outside investors are nearly always taking a risk when they invest in entrepreneurs. And number 3, entrepreneurs tend to be growth-oriented and are often interested in rapidly expanding their business operations and investments once they've found a successful model. Intuitively, we'd think that the tax code should be more or less neutral towards all 3 characteristics of a firm. For instance, if a firm has particularly large losses in its early years, we probably don't think that the tax code should penalize it for this characteristic. Similarly, we don't think that the tax code should probably present disadvantages to investing in particularly risky businesses. And finally, we certainly probably don't think that the tax code should make it more difficult for successful businesses to expand their operations. But the reality of the US tax code is the opposite on all 3. The US tax code does penalize businesses that run large losses in their early years. It does discourage risky investment and encourage safe investments. And it does present obstacles for businesses that are expanding their operations and growing rapidly. And I'd suggest that all 3 features of the US tax code are uniquely disadvantageous for entrepreneurs in the US economy, and that if lawmakers are interested in removing tax barriers to entrepreneurship, these 3 areas might be a place to start. So I'll delve into each of them one by one. The issue of early losses. Many entrepreneurs take a while to earn a profit. One great example of this is Uber, which is an internationally recognized business and has been around for over a decade and runs consistently large losses year after year. And this is a pattern that's common with many entrepreneurs. Starting up a business involves lots of fixed upfront costs. It often takes time to develop a market. Many entrepreneurs lose money before making it. So one of the natural questions to ask is, how does the tax code treat businesses with losses? And it turns out that there are 2 types of treatment in the US tax code. If you're a business that has losses, but you've made profits in a previous tax year, in a recent tax year, then you're able to carry back your loss deductions, which is to say that you get an immediate tax benefit in years that you have losses. But if you're a business that doesn't have profits in earlier tax years, then you're required to carry forward your operating loss deductions. You're not entitled to an immediate tax benefit. Instead, you can apply your losses to future income in order to gain a future deduction and a future tax benefit. Well, what's the problem with this? We know that businesses don't value future tax benefits as much as they value present tax benefits. A dollar of deductions in the future is worth less than a dollar of deductions now. So that means that if you're a firm that doesn't have pre-existing profits, that is running large losses, then you're not able to get any tax benefit until far into the future once you've turned a profit. And it's actually worse. The tax disadvantage from this means that the longer that it takes for your business to earn a profit, the more disadvantaged you are by the tax treatment of your early losses. Needless to say, this is a feature of the tax code that is uniquely disadvantageous for entrepreneurs whose earnings often whose earnings don't have a stable pattern, whose earnings are negative in the early years, positive in the later years. And if lawmakers are interested in improving the tax treatment for entrepreneurs, the treatment of carried forward losses might be one place to begin. A promising proposal in this regard actually comes from the Ryan Brady Blueprint, which would essentially pay firms interest on their carry forward net operating losses, which means that the longer that you have to carry forward a loss under the tax code, the more of a deduction that you'll be able to get. And that's one thing that could potentially even out the playing field. Another characteristic of entrepreneurs that is relevant to the tax code is that entrepreneurs are often quite risky investments. The Census Bureau has found that about 50% of new businesses don't make it past their 5th year of existence, meaning that most new businesses fail. Most new businesses do not persist. And therefore, if you're an outside investor that's looking to offer a loan to a business or take stock in a new business, that's going to be an inherently risky proposition. So another area of the tax code to examine is how does the tax code treat risky investments? And it turns out that we have a similar problem when it comes to risky investments, which is that if you make a good investment, if you make a profitable investment, then you pay capital gains tax on the profits from that investment. But if you have a capital loss, if your investment goes bad and you have to sell at a loss, the tax code doesn't have a symmetric benefit for losses. Instead, like business losses, capital losses have to be carried forward into future years. And again, investors don't value future capital loss deductions as much as they would value current capital loss deductions. The result is that the riskier your investment is, the more of a tax penalty that you have, because the more chance that you have of having a loss in your investment, the more chance that you'll be subject to this unfavorable tax treatment. So another area of the tax code that might be worthwhile to look at is how the tax code is treating losses by investors who are pursuing the type of risky opportunities that entrepreneurial ventures often present. And there is one section of the tax code right now that attempts to address this issue, which is Section 1244, which provides an immediate deduction for some capital losses of qualified small business stock. Now, the section isn't designed perfectly, but it's one answer to this question of how we can remove tax barriers to particularly risky investments that might be in entrepreneurial ventures. The final area of the tax code that I'd like to point out, and the final characteristic of entrepreneurs that is tax relevant, I think, is that entrepreneurs are often growth-oriented. They're often interested in growing their business as rapidly as possible. And that often means undertaking large capital investments, like building new machines or equipment, or purchasing new buildings, or so on and so forth. And counterintuitively, the tax code provides worse treatment for capital investments, for the type of investments that lead to business growth, than it does for other sorts of business expenses. If you've got an ordinary expense as a business, like heating costs or air conditioning or postage, then you've got an immediate deduction for that expense. But if you've got a capital expense, like a new drill or a new factory, you don't get an immediate deduction for that. Instead, you have to write off that investment over many years according to a set of depreciation schedules that range from 3 years to 39 years. And of course, the issue here is similar to the last two issues, which is that if you're writing off a piece of equipment over 39 years, a deduction 39 years away in the future just isn't worth that much for you. And this is a feature of the tax code that discourages businesses from making capital investments in machinery, equipment, and factories, the things that enable businesses to grow. Now, there's one provision in the tax code that's meant to alleviate this partially. That's Section 179, which is very popular among small businesses. And what it does is it allows businesses that are below a certain size to immediately expense all of their investments, or most of their investments, which means you get a full and immediate deduction for those. But of course, if a business is in growth mode, then eventually it'll grow out of Section 179. It won't be applicable to them anymore. And then they'll be back to the depreciation schedules, which are complex and discourage investment. So one policy solution that many have proposed is full expensing, which would essentially be to give capital investments the same tax treatment as all other business investments, allow you an immediate and full deduction for your capital expenses in order not to place barriers to small businesses and entrepreneurs that are growing. In summary, there are a couple of shared characteristics of entrepreneurs that are relevant to the tax code and that the tax code presents barriers to. And I'll add one more thing, which is that all of these barriers are distorted even more by the fact that our tax system has relatively high marginal tax rates. So for instance, if you're an entrepreneur organized as a corporation, you're subject to the highest corporate tax rate in the developed world on a marginal basis. And then you're also subject to a second layer of tax on your dividends and capital gains. Right now, the top tax rate on capital gains is the highest it's been since 1997. Top tax rate on dividends is the highest that it's been since 1986. If you're not organized as a C corporation, you have the benefit of not being subject to the double tax regime. But that also means that you're subject to the individual income tax code, which has a top rate on pass-through businesses of 44.6%, which again is the highest rate that we've had on non-corporate business income since 1986. All of this is to say that if lawmakers are interested in removing tax barriers to entrepreneurship, both the structure of the code matters in terms of what deductions you're able to take and not take, and also rates matter in terms of rates that are exacerbating some of the distortions in the rest of the tax system. So that's all I'll say for now, and I'll turn it over to Tom, who has some real-world experience working with businesses.
Thank you very much, Scott. Tom?
Thank you, Scott. Thank you, Scott and Scott. I'm here to give you kind of the micro-level view of all of this, and you're going to find it's not inconsistent with what's been said already, but it is a little different look at it. The first thing, I suppose I don't want to hurt the federal government's feelings, but the first thing I should say is that entrepreneurs really don't give two hoots about tax policy. They really have one major consideration, and Scott made it clear too, and made it clear why, and that is essentially it is absolutely critical for every struggling, especially the new entrepreneurs, for the cash coming in to be greater than the cash going out. Now that may not always happen the first couple of years, but no entrepreneur has unlimited capacity to absorb losses, and that cash is clearly king, especially for the new entrepreneur. That has a lot of implications. First implication, consistent with what Scott was saying, and that is that rates make a difference. When I first started practicing, it was in 1979. The top rate was 70%. The top rate went down to 50% not too long after that with the Economic Recovery Tax Act, and then the Tax Reform Act of 1986 brought that top rate down to 28%. Well, there were a couple of different characteristics, a couple of things, changes in behavior that I saw happen at that point as a consequence of that tax rate change. Number one, clients of mine that previously had been worried about tax shelters and how they were going to shelter their income and how they were going to essentially deal with the tax code, because at those rates, it was a barrier. It was, you add state and local tax onto that, and essentially more than half their income, more than half of any given deduction, more than half of any expense is being taken away. And what it did had, number one, they're looking at tax shelters. How do they do battle with this additional obstacle? It's not as though entrepreneurs don't have other obstacles, but how do they do battle with this obstacle at 50% or plus 50% of their net income? That's a real obstacle, and they have to take it into account. Well, once the tax rates came down, somewhere around 28%, state and local adds to that maybe a little over 30%, there was a sea change in behavior. They started to stop thinking about the tax code as a barrier, and they started to think in terms of, okay, I'm going to pay tax at that rate. Tom, just tell me what the rate is. We're going to reserve for that. We'll handle that, and that'll be the end of it. And they also, the other thing that happened was they started to be thinking in terms of when they were spending money, they started to be thinking in terms of spending their own money. Because frankly, when the tax code is giving you a subsidy of 70% or 56% or whatever it is, at the end of the day, and I saw this happen. In fact, clients and entrepreneurs and owners would say to me, well, I'm not paying for this. The government's paying for this. And it literally changed the way they look at things. And so as a consequence, I can't emphasize, as Scott has already emphasized enough, that rates do make a difference. And I have one handout, which you probably saw, and it's this graph of S-Corps. And essentially what it says is if you look at the beginning of the graph before the Tax Reform Act of 1986, roughly 20% of corporations were S-Corps, and probably a lot of those were loss corporations. In other words, corporations that were experiencing losses, they wanted to pass them through and have their entrepreneur owners use it against other income. Then, over the course of the next 30, 40 years, essentially that, instead of being 1 in 5, the percentage of corporations that became S-Corps, and that either new corporations or ones that converted, got all the way up to about 70%. And this shows you that, and what were they looking for? They were like, you've got a tax system. S-Corps have two wonderful characteristics, at least at the time they did. And number one, there was a reasonable rate. It was a rate that entrepreneurs could get comfortable with. Okay, if that's the toll charge for everything we get out of government, I can pay that. I'm not going to treat it as an enemy. But the other thing, too, about S-Corps is there's only one tax. So I don't have to pay tax at the corporate level and then worry about planning and try to defer that second tax and all of those things. So those two things, and you can see, obviously, the entrepreneurs over time clearly responded to an improved tax structure. They didn't respond immediately. Why didn't they? Because they've got a lot of other obstacles and things to worry about. On the other hand, over time, they're going to figure it out. And they did figure it out. And that's so rates do matter. Two other things that I want to just talk about, just in terms of categories of issues that come up at the entrepreneurial level. One is the idea of unintended consequences. And here I'm going to add just a vignette onto what Scott was talking about in terms of expensing. There was early in my practice, an entrepreneur called me up and said to me, Tom, I've got a problem. I just made $1 million last year, my first $1 million. And, I was hard pressed to figure out what the problem was so far. And he said, I got computers, I got furniture and fixture, I had equipment, and I've got all of these other things, and I think my business model's working and things are going great. And I said, well, yeah, okay, what's the problem? He said, you don't understand, Tom. I just talked to the accountant, and I owe tax, and I don't have any money. I earned $1 million, and I spent $1 million, and that. To me, it brought home two major points. One is that the entrepreneur, especially the startup entrepreneur, lives out of his or her checkbook. At the end of the day, what you do to their cash position is absolutely critical. And they're reminded of it constantly, because at the end of the day, if they're going to stay in business, any negatives need to be reversed, and frankly, the positives need to be high enough to absorb expenses and unexpected occurrences and all of that. And so, and the other thing is that they will respond, and this was a situation where it brought home to me, and I was thinking, my reaction was, when I was trying to explain to them, well, you're going to get the benefit of those capital expenditures over a period of time. I didn't get halfway through that explanation. And that's irrelevant. I don't care about what the benefit is. I need cash now. And that brings home, and the other thing to keep in mind is that same $1 million that was spent on equipment for that individual made $1 million, spent $1 million. That same $1 million was spent to some other entrepreneur who incidentally paid tax on that $1 million. Now, maybe they didn't make a whole $1 million because they had $900,000 of expenses in terms of generating those goods and services, but at the end of the day, that's the person on a cash basis that actually earned a profit. And if we're going to focus on tax policy, especially for new entrepreneurs, it's when they actually are making a profit, that's when they can afford to pay tax. And you don't want to discourage standard constructive entrepreneurial behavior by essentially saying to them, well, notwithstanding the fact that you're cash flowing negatively, we want some tax as part of this process. So that falls in the category of kind of unintended consequences, and as Scott says, Section 179 helped to alleviate that. Not completely, wouldn't have taken care of my guy, and $1 million is a lot more money back then, but that still, that's a significant step forward. Another thing that has come up in my practice, and this one falls, in my opinion, in the category of unforced errors, and that is many, especially smaller businesses, when they start out, they're not in a position where they can have like group health insurance. And so they try to help out people, and they've got staff and employees. They want to keep them happy and they want to keep them there. And sometimes they find themselves in a position, well, we don't have health insurance, but I tell you what, if you go and get an insurance policy on the private market, I'll reimburse you for that. In fact, that particular technique has been blessed by the Internal Revenue Service for years and years. The Affordable Care Act came along, and it did not prohibit that. The Affordable Care Act did not prohibit it. There was nothing in the Affordable Care Act that said that that's wrong. But essentially what happened is the IRS came out with Notice 2013-54, and it essentially said, okay, we've got all these market reforms, and the market reforms require you to have an unlimited cap. There can be no cap in your group health plan. Okay, I understand that. And if you have, an employer has a group health plan, and that group health plan reimburses insurance premiums, by definition, even if it's not in the plan, by definition, there's a cap on how much you could possibly reimburse them. So as a consequence, we're going to interpret that as a cap, and we're going to say to that entrepreneur who's just trying to keep his staff or her staff, we're going to say to that entrepreneur, well, you can't do that. You can't reimburse that premium. And you might say, well, okay, what's the penalty for reimbursing that premium? Well, the penalty is $100. $100 per day, per employee. So that essentially you're talking about $36,500 for reimbursing health insurance premiums. If you've got 10 employees, you're talking about $365,000. The reason I call that an unforced error is look at what it's doing and look at the impact that it has on the individual entrepreneur. Especially in the startup mode, they can't afford to come to lawyers and accountants and ask the lawyers and accountants every single time, can I do this, can I do that? There's got to be some intuition. It's got to be intuitive. It should be intuitive so that when they do things, they don't potentially back into a $365,000 penalty for doing something like reimbursing health insurance premiums that really on its face doesn't look wrong to them. They can't, and so as a consequence, that, in my opinion, falls in the category of unforced errors. Situation where there may or may not be a policy problem that should be resolved, but the resolution, the rule set that is put in place in order to solve that problem is much more intrusive and way out of proportion and essentially hurts the entrepreneur with no corresponding benefit to the economy as a whole or, frankly, encouragement of entrepreneurial activity. So with that, I will shut up.
Well, thank you very much. That's a good perspective and a frightening story, actually. Tim.
Thanks. So I tell you right up front, I'm going to know less about tax policy than the rest of my panelists and Scott, but I know a little bit, and I've started some businesses. I've done research on entrepreneurship. My first business was in 1980. I was 12, and comic books were getting more and more expensive. You remember the inflation of the late 70s. I'm talking 25 cents to 60 cents in 4 years. It was pretty rough for a kid. So I decided to mow lawns that summer. I printed up a flyer and I delivered it all over the neighborhood and nobody called. Until mid-August, got this phone call one evening. I was watching Hogan's Heroes, I think. I don't know. And this lady said, $5 is on your flyer to mow a lawn. Is that still, you're still doing this? I was like, absolutely. Okay, can you come tomorrow? So I went the next day and I'd agreed to mow her lawn. And she had like the biggest lawn, it turned out, in the neighborhood and hadn't mowed it all summer long. So the grass was about, this tall. I started learning about entrepreneurship then, how to negotiate. And one of the lessons is entrepreneurs really need to focus on their business, and they put a lot of energy into that. I've started other companies that are internet companies. I've started software businesses, taken venture capital and lost a lot of it. Started a business with a friend that took no investment at all and was in that $1 million situation where we were dirt poor for years and years and years, just starvation. And then we got acquired. We became, a dominant player. And we made $1 million. It was, like this Hollywood comedy, $1 million. But we had to split it among, the 3 partners, and we gave some to our employees. And my buddy put all of his internet stock. My wife and I decided we wanted to put a down payment on a house. That's all we had money for, and did not even think that Uncle Sam would said, no, you're rich now. You're the 1%er. Because we'd been, I literally didn't pay myself for 4 years while we were running this business. I was a grad student at the time. And the attitude of the government, so when Scott asked me to talk about the barriers to entrepreneurship, I remember when we tried to hire our first employee. Now, this isn't necessarily federal tax code and what can we do with reform, the House Ways and Means Committee. It's that I tried to hire somebody. And we had 3 partners, and we were bursting at the seams with the work we had to do. We said, okay, we'll hire our first employee. That is a seminal moment for an entrepreneur, and it's terrifying. Because what if you hire them and they end up suing you? Or what if they get hurt, right? Or what if everything goes well, but some tax person from the government says, no, you're doing it wrong, you're going to jail? I mean, my partner, Jim Coyer, was just terrified of hiring a person, but we had to do it. And so, we filed whatever paperwork we thought we had to file and alerted the authorities. We're hiring a person. And we got a stack of papers in the mail from the state of California and the federal government. Congratulations, oppressor of the working man. Fill out all these forms. The one that got me, though, because, here we are, there's an unemployment problem in America. There always is. There are always unemployed people. Entrepreneurs, as Scott said, create 3 million jobs a year. Startups, not existing companies. Existing companies altogether cut 1 million jobs a year. Startups create 3 million. That's something you probably want to subsidize, not tax. But no, the top form was you need to start paying the unemployment tax because you're employing somebody. Now, if there's anything more oxymoronic in our tax code, it's that we've got an unemployment tax for people who employ Americans. I still don't get it. That's just one. But I think there are 2 other big features of the tax code at the federal level, the good old-fashioned federal tax code. One feature, and that is how do we count income? Because you're in this game long enough and you start, it just, this one mantra pounds into your brain. The way to get a better tax code, the way to grow the economy is to tax consumption, not income. Right? When you try to tax income, you start to play this big game of, well, what is income? And I'll tell you what bothers entrepreneurs is they don't have all the fringe benefits that big companies do. And big companies get away with having those as untaxed benefits. Healthcare is a big one. So when you're a kid trying to mow lawns or you're a software developer, you really, as Americans, we want those people to focus on what they're doing, not figuring out all the nooks and crannies of the tax code. That's a burden. That's a barrier, right? So it turns out, I was researching this last night about what counts as income. Fringe benefits don't count as income. That makes it a very unlevel playing field between entrepreneurs and existing larger companies. With gold-plated healthcare, with gyms, with company cars. And the government says, no, fringe benefits don't count as, fringe benefits have to count as income. They have to show up on your pay stub as income with a few exclusions. So I thought I'd look up the list of exclusions. This is from publication 15B. Accident and health benefits, achievement awards, And tell me that's not a big loophole. This isn't payment, Donald. It's an achievement award, right? Adoption assistance, athletic facilities, dependent care assistance, educational assistance, employee stock options. Okay, this is only half the list that I got to. It's very frustrating as an entrepreneur because I'm trying to build software and I don't have time to figure out all this stuff. And it's very hard. If I were to start a company, it would be very hard for me to induce you to join the startup because it's risky, because we don't have these benefits. So you'd think out the gate the deck is stacked against us, but the tax code makes it harder. And I think having an income tax code instead of a consumption-based tax code makes it extremely harder by definition. So again, let me go back to 1980 because I want to emphasize a few things. GDP in 1980, real GDP, inflation adjusted, including comics, was $6.4 trillion. Now it's $16.4 trillion, at least as far as 2015. GDP per capita was $28,400. Now it's $50,700. So, people say life is getting worse and worse and worse. We've had pretty phenomenal growth under Republicans and Democrats. But here's the scary thing. Startups per capita in America, per 1,000 people, there were 2. And remember, these are creating a lot of jobs, right? Today, it's 1.2 startups per 1,000 people. 1 in 6 companies when Jimmy Carter was president were startup companies every year, year after year. Now it's 1 in 12. So 35 years from now, on this trend line, which we shouldn't be chartists, but there won't be any startups because we're making it harder and harder and harder. Last thing I want to emphasize, this is a little bit out of the wheelhouse, but I think it's so important. This is a great study from NBER that I don't want to forget in 2002 from Robert Gordon and a co-author. They analyzed what would happen if you went to a flat tax, replacing the current personal and corporate income taxes with a 20% flat tax should virtually triple the amount of entrepreneurial activity, even with the remaining distortions under the payroll tax. Triple. I think that'd be good since these create all the net new jobs in America. Now, I want to make one more point and beat my own drum a little bit. I'm not as distinguished as an economist, but I did publish one thing that gave me a little bit of notoriety. It was in 2010. President Obama cited it. The Economic Report of the President cited it. And it's finding out that startups create all these net new jobs. And that was my claim to fame. And it surprised me. I'd been an entrepreneur. I've been an economist. I didn't know how important they were. I don't think enough economists know how important they are. But the fact that they're declining should be terrifying to us. And the regular order of business is probably not going to work. So the last technical point I wanted to make was I've tried to encourage all my children to start businesses and warn them about the lawnmower lady problem. In Virginia, if my daughter Catherine wants to start a business, she's thought of starting a dog zoo, which I think is kind of cool. Just to exist, just to file with the state of Virginia for a pass-through LLC is, I've got the numbers right here. It's $100, and then it'll be a $50 annual fee. No profit, no employees, just to exist. So I'm looking for the state where they encourage entrepreneurship, where they tell kids, we're not going to tax you just to start companies, and there's none. They range from $1,000 of combined fees in Massachusetts, $400 in Maryland, $520 in Washington, D.C. There's not one governor who said we're going to be the startup state, and we're not going to tax, they're called fees, the raising revenue, just for companies to exist before they made any money. Now you'd think, well, come on, Tim, they've got to process all that paperwork. So it's got to come from somewhere. Virginia, $100 for the initial filing fee. I calculated last night with the number of startups in Virginia per year, they make about $3.2 million from that. That is not significant revenue, but it's just enough of a hassle that if you're a high school kid or you're a recent college graduate and you think maybe you'll start something on the side, it's just starting you off with that smack in the face, we're going to make it hard for you. And not one governor has said we'll make it zero in our state. I find it baffling. So. Thanks very much.
Thanks, Tim. Donald.
Great. So hi, everybody. It's a great treat to be here. So I'm Donald Marin from the Urban Institute and also do a lot of work with my colleagues at the Tax Policy Center. In the last few years, we've done a bunch of things in the space of thinking about taxes and entrepreneurship, and want to leave you with kind of 5 takeaways from that. A bunch of these will sound familiar. The beauty and curse of going last on a panel like this is that many of the things I'll say you've already heard, but I will say them with different words. So the first, I think, unifying theme when you dig into taxes and entrepreneurship is that it's really important to recognize all the different players, and that you need to think about how all of those different players are taxed and interact with the tax system. So obviously, you've got to think about the entrepreneurs, got to think about the founders of the businesses. If it's going to be a business, you have to think about how the business is going to be taxed. Corporations versus pass-throughs, that set of issues. If they're going to raise outside capital, you have to think about how the outside investors are going to be taxed and whether that affects the ability of the entrepreneur to raise money. And as we had the example from Tom earlier and from Tim, you also have to think sometimes about how employees are taxed and about how that then flows back to the entrepreneur and the opportunities that the entrepreneur is faced with. And so, to the extent you can, when grappling with these issues, try to think about all the pieces and how they fit together. And sometimes it's insufficient just to look at a single piece, and you need to think about other portions. So we had some examples before of the various pieces. This comes up in a lot of contexts when you're thinking about reform proposals. For example, if you make changes to the corporate income tax, you might at the same time want to make changes to the way you tax capital gains and dividends. Right? That gives you some flexibility to accomplish things you may want to accomplish. Not directly on point for today, but if you're interested in the carried interest discussion and about how carried interest is taxed, that debate in public is 99% about how the recipients of carried interest, the fund managers, are taxed. But I have a recent paper that talks about thinking about how the investors and the funds are taxed. And it turns out that if you expand your scope to think about not just the manager but the investor, you can have a much more nuanced and, in my view, interesting discussion about how carried interest ought to be taxed. So think about all the pieces. Second point, we're mostly going to talk about incentives and money here, but again, some of the comments earlier, particularly from Tom and Tim, emphasize that another thing that is very scarce for entrepreneurs is just mental bandwidth, right? There are lots of things they have to deal with, and one of the things you would like in a perfect tax system is to not overtax just their mental capacity to make decisions, right? There's lots of psychological research about how you don't want to have people make too many decisions. You get worn out, right? President Obama had this famous example of laying out the suit in advance and only wearing 2 suits, right, to minimize the number of decisions he has to make. You don't want a tax system that torments the entrepreneur with having to make lots of decisions, particularly when they're not certain about what the effects are. I'm sure they all want to be friends with Tom, but you would like to cut down on the number of phone calls with Tom. No offense. And so just think about ways to make life easier for things that have nothing to do with the money and the incentives, but just the burden. And I would note there that the IRS periodically does these very helpful surveys of the compliance burden of the tax system. And there are clearly economies of scale in dealing with the tax system, right? So if you're GE or Pfizer or some large company, dealing with the tax system is a relatively small cost of doing business. But if you're a small, business, a few $100,000 in revenue, a couple million in revenue, it's a much more significant share of your revenue that's going to compliance. Not paying the taxes, but figuring out what taxes you have to pay. And I think there's still room for policymakers to think about ways to alleviate that burden more, so that it isn't as much of a burden on the smaller and new firms. It's important to emphasize that the tax code as it exists today does include some incentives for small business and for entrepreneurial efforts, right? So there's some favorable capital gains treatment if you invest in young new businesses and hold on long enough. As Scott too mentioned, there's expensing, right? So if you invest relatively modest amounts, you can get full expensing rather than have to depreciate. There are incentives like the R&D incentive to try to encourage investment in IP across firms of all types. So there is some effort in the tax code to try to encourage innovation, to try to encourage entrepreneurship. We should keep that in mind that those are out there. As we are in the middle of the tax reform discussion, one interesting thing to keep in mind is that the existence of these previous incentives complicates life if you're trying to design a new tax system, because all of a sudden there are now embedded things in the tax code that are benefiting certain companies, certain businesses, that they may be loath to give up. I think the most important example of this has to do with expensing and interest deductibility. That kind of the canonical tax economist view of the world is that if you want to go towards something that looks like a consumption tax, looks like a cash flow tax, whatever you want to call it, allowing full expensing of business investment immediately makes a lot of sense, and it helps from a cash flow point of view for startup businesses. But in most cases, that ought to be paired with eliminating interest deductibility, because if you allow full expensing and you allow interest deductibility, you end up in a case where firms that are able to put some leverage on their investments, get some debt, they can actually have negative effective tax rates. And the goal here isn't to have negative effective tax rates. The goal in some level should be to have a uniform neutral playing field. And so there's a lot to be said for if you want to go to full expensing to roll back or eliminate interest deductibility. But then you run into immediately this challenge, which is there's a category of business, basically the ones that make small amount of investments today and already qualify for expensing, for whom that trade looks terrible, right? Because they're only getting the spinach, right? They would only get to the eliminating the interest deductibility, and they're not getting any of the ice cream of being allowed to expense their investment because they're already getting the ice cream. And so that complicates that whole set of discussions around what sort of investment incentives or investment treatment you want to have in the code. Finally, I want to get back to this point about the level playing field and about how the effective tax rates on business investment differ significantly across different firms. So they differ significantly across industries, depending on issues about like how favorable the depreciation schedules are for different types of investment, and the extent to which you have in fully expensable things like a lot of investment in IP versus investing in equipment and structures, which will be spread out over time. There's obviously the difference between pass-throughs and things structured as corporations, where pass-throughs are taxed less. There's this issue about whether you finance yourself with debt or with equity, and the tax code has a significant advantage if you're able to finance yourself with debt. One implication of that, which I'm not sure is widely appreciated, is that different kinds of firms have different abilities to rely on debt financing. And this is overgeneralizing a complicated world out there, but in general, firms that invest in sort of intellectual property kinds of things, sort of innovative new ideas, tend to rely more heavily on equity as their financing mechanism, basically because there's nothing there, or it's very hard for your lenders to repossess your collateral, right? It's one thing if you need an SUV for your business and your lender can come repossess it and drive it away. It's another thing if you invest in inventing some new idea. And so there turns out that there's this disincentive or unlevel playing field in the code that's favoring sort of the folks who can invest in the tangible repossessable assets that can be financed with debt versus the folks who are investing in the new ideas that require more equity behind them. And then there's this issue that Scott number 2 emphasized that I want to emphasize of if you're a young business, you have no history of making profits, basically because you're young and often because you're making losses right now. And so as he described, there's this asymmetry where if you're in loss-making mode, the government isn't writing you checks back. Right, it is, if you're a giant corporation, you suddenly fall into losses, you can get rebates against the taxes you paid in the past. But if you're a company that's just starting out in life, you're making losses today, the ability to get tax credit for the appropriate write-off for those losses is going to be delayed into the future. And then furthermore, the ability to take advantage of those losses may disappear if you're acquired. So under some types of acquisitions and outside equity investments, those disappear. And there's no logical tax policy on a whiteboard reason for that, right? In a perfect world, you want a neutral playing field, symmetry, all of those good things. Now, in the messy real world, there's a good reason for some of that, which is if you go for too much neutrality and too much flexibility, people get creative at creating tax shelters that cause the government to write checks to them. And so you have to find some balance in there. But at the moment, as Scott mentioned, right, the balance is such that still kind of the new startup businesses are disadvantaged relative to the established players. And that thinking about reforms that can move in the direction of leveling that playing field would remove one of the tax sort of penalties on entrepreneurial effort. Thanks.
Well, thank you very much. Maybe if we can pull back. I want to follow up on some of those asymmetries or the unlevel playing field. And so, Tom, if someone comes to you and say, "I want to start up a new business," how do you advise them in terms of what form based on the tax code? Because I think that's an issue we kind of glossed over, although Donald, I think, was hinting at a lot of that. What do you say? Well, I want to be an S Corp versus an LLC versus a C Corp. What are the decision points in there that an entrepreneur needs to think about?
There's a whole hierarchy of things that you need to ask them. Probably the biggest thing you need to ask them is, do you ever plan to sell? If they ever plan to sell, the pass-through, well, and then you've got to ask them one more question. Do you plan to sell stock or do you plan to sell assets? And if you're selling stock, then you need to seriously consider whether or not, and I know you asked the question, it gets complicated. If you sell stock and you think you're going to be able to sell stock down the road, and then you want to consider the possibility of qualifying for 1202 stock because you can get significant exemption opportunities when you actually do sell your business down the road. If you're not selling stock, or if your likely purchaser is going to want to essentially buy assets to get a step up in basis, that type of thing, then you're probably going to want to have a pass-through structure. There are literally dozens of other things that go back and forth, but that's probably the biggest one. There are other things. Fringe benefits are more available, let's say, inside C corporations versus inside the pass-through entities. So you've got, I could go down to several of them, but I would say step number one, or question number one, is, do you ever plan to sell? Now, a flip side is they could say, well, I'm not going to sell. This is a family-owned business. I'm going to own it till my death, and I'm going to give it to my kids. Well, then that's a setting in which the sale transaction is not all that much controlling. And then, C corps have a starting rate of 15% on the bottom $50,000. And they've got better fringe benefits. I mean, I can dream up scenarios in which C corporations can make sense for a starting business. On the other hand, realistically, most entrepreneurs don't get past the idea that, well, let's see, if I sell, I'm going to have to pay 2 levels of tax versus paying 1 level of tax. I mean, that's a huge difference for an entrepreneur, and most of them don't want to say no to that possibility.
I want to be sure to take your questions, so please, and we have microphones at the ready. Yes, sir. Let me see if we can get just a microphone there.
Thanks for a great. I can hear me. Is it on?
Yeah. Sure.
Okay. Thanks for a great program. It's very, very interesting. One question, and then actually two. So Don and Scott talked about 2 similar problems. One is that startups are sustaining losses most frequently in their early years, year after year after year, and they can't claim those losses for years. The other one is related, is capital expenditure investment, that if they're larger than the small business allowance, they can't claim those as well for years and years and years. Does the tax code make any distinction, or are the rules essentially the same for when you're eventually able to deduct either losses on things other than capital expenses and capital expenses specifically?
Sure.
Does that make sense?
Yes. So my broad understanding of the way that it works is that for a given tax year, you first figure out how much of your capital expenditures from that year and prior years you're able to take a deduction for. And then you see whether you're in loss territory or not loss territory. If you're in loss territory, then you count up your net operating losses and hope that you have gains in future years to apply them to. Does that make sense?
Yes. Is there a difference in terms of the rate at which, is there any distinction made in terms of how you can offset future income in terms of capital expenses versus non-capital expense losses, is my question.
Not to my knowledge.
Okay, I thought it was the same, but I was just curious. Then my final question is, we didn't talk about the R&D tax credit. Startups often have a lot of research and development. I mean, it's the reason why they've started a business, that they've got a new product, a new service, or they're doing a lot of investment in terms of R&D. They can't avail themselves of the R&D tax credit because they don't have any income.
Yeah.
And Senator Coons, I believe, has an idea whereby startups would be allowed to deduct their R&D expenses against their payroll taxes as an alternative to deducting them against the income that they don't have. And I'm just curious if anybody on the panel has any ideas about that idea.
Yeah, I don't know about that idea, but I've been sensitive to it and skeptical of it. It seemed like a tax credit with good intentions, but it's going to be, again, larger companies that are aware of and able to claim it. So it seems like something that would be leveling the playing field is actually making it less level. I would think scrapping it in general, that seems like a pretty big ask.
This is always an issue with trying to run your industrial policy through the tax code. If it were a direct spending program, then of course there would be no relevance of your tax position to whether you could receive R&D credit. But because it's structured as a part of the tax code, there are all of these complicated interactions. In general, this is sort of a lesson to Congress that if they're interested in subsidizing parts of the economy, do it through appropriations, don't do it through the tax code.
I can say just for my clients, for the most part, it's the R&D credit is complicated. The likelihood that they're going to take advantage of it is more a function of whether they're talking to an accounting firm or another firm that does R&D work, and they'll come in and they'll say, well, I tell you what, and this can be even after the fact when the R&D has already been done. They'll come in after the fact and they'll say, well, we'll go back, we'll figure out whether or not you've got any R&D that's going to qualify, and then we're going to get a percentage of the credit. And essentially that's something that actually gets the interest, because otherwise, in terms of the mental bandwidth, there are a lot of entrepreneurs, they've got so many other things to worry about, that's just not on the list.
Okay, I'm going to violate usual think tank protocol where I'm supposed to have the answers and instead pose a question. Does anyone here know if that provision already passed? I have a sense that it passed a couple of years ago.
2015.
Yeah, so it was part of the 2015 tax deal. Yeah.
And it's in effect now. There's guidance out on it.
Wow.
Okay, thanks.
For small business only. I mean, eligible small businesses.
It's in that big stack of papers I got, I'm sure.
Well, maybe I should, one final question, we'll get to the hardest one of all. Trying to equalize the treatment between all these business forms. Been various talk of integration. In other cases, it's as you lower the corporate rate, you're trying to lower the pass-through rate to try to keep some relative balance between the two. Final question, I guess. What's the best way to equalize the treatment of different business forms? Scott, you've written on this.
Sure. So as Scott mentioned, we sort of have these two parallel tax systems in the United States. There's the corporate tax system, which has a corporate level tax and a shareholder level tax, which is sometimes applied. And then you have the pass-through form, which is taxed at whatever brackets are part of the individual income tax. And it turns out that it's actually sort of hard to equalize the tax burden on both of these business forms. For instance, let's say that we went with a concept that's sometimes known as rate parity, where you set the corporate rate at the same rate as the maximum rate on pass-through businesses. Let's say both of those rates were 25%. Well, the tax rate on the entity levels would be the same, but corporations would still have this second layer of tax on some of their income, and therefore the pass-through business form would be tax advantaged. Or take another option. Let's say that you set your rates such that when you add up the corporate level rate and the shareholder level rate, well, those are equal to the top pass-through rate. Well, pass-through businesses could complain, and justly so, that wouldn't be equal either, because the shareholder level rate is not paid by all corporate shareholders. There are some tax-exempt shareholders, and it's also paid on a delayed basis. It's paid when the dividends are paid out or the capital gains are realized, and therefore on sort of the initial earnings, the corporation would be getting a better deal. There's a whole family of proposals known as corporate integration proposals that are meant to solve this problem and that are meant to, using some roundabout method or another, turn the corporate income tax system into something that looks more like pass-through taxes. There are also some proposals that try and turn the pass-through tax system into something that looks more like corporations, but those are no good and should be disregarded. But one example is simply have the corporation allocate its income to its shareholders. That's known as shareholder allocation, and is probably the easiest conceptually way of doing corporate integration, except it's administratively complex. Another way to do it would be to turn the corporate income tax into a withholding tax, and then have taxable shareholders be able to claim a credit for corporate taxes paid. But that adds some policy design choices and complexities also. I do have a paper on this. It's called Corporate Integration, an Important Component of Tax Reform. If you're interested in reading up on a dry topic, I highly recommend it.
I'd have a shorter answer. I'd say 2 words: flat tax.
Flat tax.
I think having a progressive structure that's so complicated, it disadvantages risk-taking, and that's essentially what entrepreneurship is. So I don't disagree with anything Scott said, but if you leave the room, you want to tax consumption, you want to try to have one rate, and then work out the details to make sure that the different entities are all paying that same rate.
So I would also put in plug for consumption taxation, although I'm more of a fan of an X-tax type structure or something that gives you more progressivity. I just want to highlight a point that Scott made about the types of investors who own corporate securities. Some of my colleagues at the Tax Policy Center took a crack at that, and their estimate was that only about 25% of investors, holders of corporate securities, U.S. corporate securities, are what you would think of as a canonical taxable U.S. investor. There are a lot of tax exempts out there, and one of the fundamental issues you have to confront as you think about reforming the system is how do you feel about that, right? And so the canonical, example would be the Harvard endowment, but you could also pick your favorite nonprofit that has an endowment.
Like the Urban Institute.
Like the Urban Institute, Tax Foundation, Hoover Institution, whoever. Or I'm sorry, I don't mean to be, so the TSP, right, for those of you who are not just in the G Fund, any of those things, own corporate securities, and you can view the corporate income tax as a way of, in essence, collecting some revenue on their behalf. You can have other views of it. But there's a question that, like if you just eliminated the corporate income tax entirely and everything was individual, how do you feel about the fact that, it's only the 25% of taxable owners that you're going after, and you have these other folks out there. So you can have different views on it, and there are different ways to think about modeling, but it is actually a really key underlying issue here as you think about this question.
I would just say, if you're talking about integration, corporate integration, you really should keep one rule in mind, and that is tax income once, not less than once, not more than once. If we can design a system to accomplish that, we've done it. And there really is no reason to have a double-layer tax system. At the end of the day, if we can manage to tax once, another thing that comes in play, not only is it tax-exempt foundations, but also foreign shareholders. And so as a consequence, if you can tax income once, and that's where the credit proposal that I think is in your materials, the credit proposal, there are ways that you could do this that at the end of the day would not be anywhere close to as distortive as the double tax system is currently. There are ways that you can do this, and I realize there's a lot of academic back and forth and disagreement. On the other hand, if you take as your touchstone, tax everything once, not more than once, not less than once, you could get there. In fact, that would be a tremendous step toward tax reform. I think it'd be very constructive.
I think it's always important to end a panel with a bumper sticker slogan, and I think that was it. Tax income only once. And that's our lesson for today. Thank you all for joining us, and please thank the panelists. And we'll keep you posted on our future programs, and keep an eye on our website because we tend to post them there. Thank you very much.